With rising interest rates, the outlook for those of us with mortgages is not looking good. According to Consumer New Zealand, around 70% of mortgages are currently either floating or on a one-year fixed rate, meaning they'll be heavily impacted should interest rates continue climbing at their current pace. In this video, I'll be discussing 10 ways for you to beat your mortgage. For some of you, you'll be wanting to pay off your mortgage quicker. For others of you, the priority will be to reduce repayments. Many of the points I'll be discussing touch on both of these points, so make sure you watch this video right to the end, as I'll be discussing many ways to save money that are not commonly discussed. Make sure to subscribe to the channel down below to see more content just like this, and without further ado, let's get into it. Let's start with the most obvious way to beat your mortgage, and that of course is to increase your repayments. If we just take a step back for a moment, let's discuss what a repayment represents. It has two parts, namely the principal component, which is the amount we are actually reducing our loan by, and the interest component, or the charge from the bank for borrowing money from them. Interest is calculated daily on the amount of the loan that hasn't been paid off, or in other words, the principal balance. By making a larger repayment, we are essentially reducing the principal balance much faster than what the bank wants us to do, and as a result, we can reduce the interest component for subsequent repayments. Structured correctly, you should find the term of your loan will reduce too, meaning you could knock years off your loan just by making a small increase in repayments. If that was confusing, let's visit a simple example. Say we have a $500,000 mortgage at an interest rate of 5% and a default term of 30 years. The bank tells us the scheduled repayments are $1,238 a fortnight. If we were to add just $20 a fortnight or $10 a week to that repayment, we would save nearly $18,000 over the term of a 30-year loan and reduce the term by a whole year, all for just $10 extra a week. We've all heard of compounding interest when it comes to investing over a long period of time. Luckily for us, this also works when making repayments when borrowing. When pursuing this option, take note that some banks may have conditions that prohibit making additional payments on fixed-term loans. Most, however, like Kiwi Bank shown here, allow you to make additional payments up to 5% of the amount borrowed. Similar to this, the second way to beat your mortgage is to consider whether you can accommodate renting a room out. This can either be a short-term arrangement, for example on Airbnb if you live in a popular area, or in a long-term arrangement with someone dependable, which could be a friend, a family member, or rented to a working professional in the area. This can be a great way to source funds to increase your repayments and reduce the duration of your loan. If we use our example from earlier, by collecting rent of $200 a week, you could reduce the term of your loan by over 7 years and save over $120,000 in interest. This option certainly isn't possible for everybody, but could be an option for those with a spare room or a self-contained unit on their property. Using an offset account can be another great way to beat your mortgage, and is a very common way to reduce your interest costs. Simply, this is how it works. You have to create two bank accounts through the bank, a savings account and an offset mortgage tranche to your loan, which simply is a slice of the overall mortgage, but it must be floating. For this example, let's assume you have $30,000 in your savings account, and the offset mortgage has a balance of $50,000. As we discussed earlier, mortgage interest is calculated daily on the loan balance. Therefore, on a classic mortgage, you'd have to pay interest on the $50,000 balance. However, through an offset mortgage, you would only have to pay interest on $20,000, which is the difference between the two accounts that you've set up, which more than halves the interest cost. This can be easily set up with your bank, and I know many people who have done just this. Commonly, people have their salary deposited into the savings account, and they move cash out when needed for daily outgoings, which is a smart way to reduce the balance of your loan on a daily basis. This can be further compounded by using the tips in my credit card video. I'll include a link above, by delaying payments to maintain a larger savings balance for the interest calculations. The fourth way to beat your mortgage is to make a lump sum repayment. Lump sum amounts can arise due to a number of reasons, anything from bonuses to tax returns to inheritances. It can be tempting to spend these amounts as they come in. However, if we instead put this towards a loan, we can potentially knock months or even years off of the term. As lump sum amounts are usually larger than what we were talking about earlier around increasing repayments, the bank may charge a range of fees for making the payment. In this case, it may be worthwhile holding on to the money until the time your loan is refixed. So just take note of this. Using the example loan from earlier, let's say we received a bonus of $10,000, 10 years into our loan. By putting this directly into the mortgage, over the remaining term of the loan, we would save over $16,000 in interest and reduce the term by 9 months. So it certainly isn't a bad option. Changing your repayment frequency can be another easy way to beat your mortgage. If, for example, you're currently paying your mortgage monthly, but you're paid fortnightly, you may be paying a lot more interest than you need to be. ASB Bank has a great example of how this works on their website. We often think of a month being 4 weeks and a fortnight being 2. If we half the monthly installment and paid that fortnightly instead, without much notice you can slip in an additional 2 fortnightly installments, which can save a substantial amount of interest and cut down the loan term. In addition to this, by making more frequent payments, we are reducing the balance of the loan sooner, and the daily interest is therefore calculated on a lower balance. The sixth way to beat your mortgage is to not reduce your repayments when your loan is refixed at a lower interest rate. This isn't so much the case right now as interest rates are rapidly rising. However, when rates are falling, as they have done for most of the past decade, this will significantly reduce the term of your loan as you're paying more than the scheduled amount that the bank is expecting. This point relates to the one above about increasing repayments, however provides a useful context that many possibly wouldn't think about. When interest rates start declining again, this is a useful point to consider which can have a very beneficial impact on your mortgage. Oftentimes, mortgage loans will have establishment fees added, such as low equity margins or loan protection insurance if you have less than 20% equity, or a fee to cover the bank's administrative functions to open your loan. Banks usually capitalize these fees at the start of the loan, meaning they essentially become a part of the loan principal, which has interest calculated on it. To avoid paying interest on these fees, make sure to pay these in cash outside of the loan, if you can, to avoid the additional interest costs. The eighth way to beat your mortgage is to renegotiate your interest rate, or even negotiate with other banks to refinance your mortgage. In today's environment, companies are very transactional and give new customers lots of incentives while offering very little to existing customers. Have you ever seen a promotion for half prices to new customers, but you've been loyal to them for a number of years and received nothing? Banks are no different, and without assessing your rates relative to the market, they could be screwing you on your mortgage too. In this case, it makes sense to renegotiate your rates when it comes time to refix, and shop around with other banks in case they're offering better rates or even sign-on benefits. As an example, here's an offering currently on the market from Westpac. They're offering $5,000 to move your mortgage over to them. If you do go down this route, make sure to always check the fine print, as commonly there's a minimum term you must stay with them to keep the whole $5,000. To save the hassle, try negotiating with your current bank, as they might match the offer to have you stay with them. Reducing the term of your loan from the outset can also beat your mortgage. Banks by default will generally set you up with a 30-year term. This means it'll take 30 years for you to pay off your loan if you pay their calculated repayments consistently on time. It also means you'll be paying your loan off slower than, say, a 25-year term, meaning you'll pay more interest overall. Therefore, if you can find ways to afford the additional payments to reduce the term of your mortgage, this can be a straightforward way to pay the loan off faster and pay less interest too. The 10th and final point to beat your mortgage is to avoid taking unnecessary mortgage holidays where your repayments are less than your stipulated amount in your loan contract. Despite being called a holiday, these are anything but. When you return from your holiday, one of two things will happen. Either your repayments will increase and the term will remain the same, in other words, you're catching up for payments you missed, or on the other hand, you'll pay the same amount as you were before, but the term of your loan will get pushed back. In essence, by taking a break from repayments, the interest continues to accumulate on your loan. However, it is instead capitalized and compounds every time you miss a payment. Now, in most cases, there will be legitimate reasons for taking a holiday, such as where you've lost your job and cannot make the repayments. But in all other situations where you choose this out of convenience, this can have a very serious impact on your loan. So it pays not to do this. So to summarize, there are many ways to beat your mortgage. We've spoken about increasing repayments, reducing the loan term, making lump sum repayments, negotiating with other banks, and using offset accounts. If you enjoyed this video, please make sure to like the video and subscribe to the channel down below to see more content just like this in the investing and personal finance space. If I missed any other points that you think others could benefit from, please drop a comment down below. I'll be replying to everybody that does. Thanks for watching, and I look forward to catching you on the next one. Cheers.